Iron Financial. Look, you don't need me to tell you that the current macro environment is, well, it's incredibly fragile right now. Tech stocks are wildly volatile. Inflation is proving way stickier than anyone in Washington wanted to admit, and frankly, the foundation of the broader market feels like it's built entirely on sand. We are here to help you forge a stronger portfolio and cut straight through that market weakness. I'm your lead analyst, and today we're looking at a company that literally claims to keep the world working. We are going to rip into their financials, we'll look at the revenue, the debt, the margins, and find out if this foundation is truly solid or if it's quietly cracking under pressure.
Right, and I'm your market skeptic. I'm here to represent you, the audience, and I've just got to ask the obvious question here. Why are we spending time on a seemingly boring industrial stock when everyone else is mesmerized by AI and flashy tech? Well, it's simple, because when the market gets shaky, you need a business that actually builds things, not just algorithms. I want to know if what we're seeing today is just Wall Street hype, or if there's real, undeniable structural necessity here. So let's get the blueprints out and see what we're really building today.
So today we are diving into GWW Grainger. Ticker symbol is GWW. Now this is a massive $55.38 billion behemoth operating primarily in North America and Japan. To put that $55 billion into perspective for a second, that market cap makes Grainger larger than Ford Motor Company. It's larger than Delta Airlines. They are absolutely massive. But, as we know, size alone doesn't equal strength. The critical question we have to answer in this explainer today is this: is Grainger an ironclad structural necessity for your portfolio, or is this just a really heavy, overpriced valuation trap that's just waiting to collapse on unsuspecting investors?
And that is exactly what we are going to drill down into. Because a $55 billion market cap in the industrial distribution sector, that demands absolute scrutiny. We have to look way past the ticker symbol and examine the actual physical nuts and bolts of their daily operations to see why they command that kind of premium price.
To really understand Grainger, you have to ground yourself in the physical reality of what they actually do. Look, this isn't some software company built on vapor and promises. This is a heavy-lifting, physical business. They are a broadline distributor offering more than 35 million maintenance, repair, and operating, or MRO, products globally. 35 million. That is an absolute logistical masterclass. Think of the sheer complexity of a massive Amazon fulfillment center, but strictly built for the heavy industry, commercial construction, and manufacturing sectors. Okay, so we're talking about literally everything from, safety helmets and heavy-duty wrenches to massive HVAC equipment and industrial motors. 35 million individual items. I mean, that is a staggering footprint. But let's be real here. Having a giant warehouse full of parts doesn't automatically mean you're building a profitable empire. Anyone can buy inventory. The real question is, who is actually buying all of this stuff? And more importantly, how are they moving it without just completely drowning in overhead costs?
Well, they are moving it through a massive, highly structured distribution network. Grainger serves more than 4.6 million active customers worldwide. 4.6 million. To handle that kind of daily load, they employ a workforce of nearly 25,000 team members, and they partner with over 5,000 primary suppliers. 4.6 million customers. See, that is the exact kind of diversification I like to see. It means they aren't just relying on a handful of mega clients to keep the lights on, right? They're selling to the local commercial plumber down the street, they're selling to massive automotive assembly plants, and giant government municipalities. If one sector of the economy stalls out, the whole building doesn't just collapse overnight. But still, employing 25,000 people and managing a supply chain of that absolute magnitude? That requires a ton of cash. If the broader market weakens, that massive infrastructure could very easily become a massive liability.
Okay, well, let's initiate the drill down. Let's look at the actual financials. In 2025, Grainger established a very solid foundation, reporting $17.9 billion in sales, which was a 4.5% reported sales growth. But look at the explosive momentum they had in the first quarter of 2026. Sales hit $4.7 billion. That's a 10.1% increase, or a massive 12.2% jump on a daily organic constant currency basis. To translate that out of Wall Street jargon for a second, that means stripping out all the noise. No currency exchange rate tricks, no buying growth through expensive acquisitions. They are growing 12.2% purely on the sheer strength of their core day-to-day operations. Market Skeptic. All right, I'll admit, 10.1% reported growth in a single quarter is super impressive for a mature industrial giant. It looks like the demand environment is holding up remarkably well despite all the geopolitical uncertainty out there. But hold on, driving top-line sales is really only half the battle. If they are aggressively slashing their prices just to move that heavy inventory off the shelves and pad the revenue numbers to look good, then that growth is completely hollow.
Well, the data shows they definitely aren't slashing prices. In fact, they are expanding their profitability.
In Q1 2026, Grainger achieved an operating margin of 16.7%. That is an increase of 110 basis points compared to the first quarter of 2025. Simply put, that's a full 1.1% increase in profitability on operations. This proves their structural integrity against inflation. They aren't just surviving, they're thriving.
Wait, let's make sure we put that number in context. Typical industrial distributors usually operate on razor-thin margins, maybe 3, 4, or 5% if they are running a really tight ship. So a 16.7% operating margin for a distributor, that is undeniably strong. It tells me they aren't just some middleman taking a tiny, easily replaceable cut. They are providing enough vital service that their customers are actually willing to pay a premium. But I have to wonder, how much of this is real, sticky pricing power, and how much is just temporary luck with, say, favorable freight costs?
It's pure pricing power. And here is the hard proof. Just look at the gross margin. It hit a rock-solid 40.0% in Q1 2026. That's actually up 30 basis points. And in their high-touch solutions segment, it was even higher at 42.6%. Think about what that means in the real world for a second. When the cost of steel goes up and suppliers hike the wholesale price of a heavy-duty wrench, Grainger doesn't just eat that cost and bleed cash. No way. They instantly rewrite their catalog pricing. And their customers, who desperately need that specific wrench today to keep a factory assembly line running, they pay the premium without blinking. That right there is a 40% gross margin moat.
Wow, 40% gross margins in industrial distribution is some serious armor. They are completely insulated from supplier hikes. But this brings up a really crucial point about how their overall business is actually constructed, because not all of their revenue streams are built with the exact same grade of steel. Let's actually look at the segment breakdown.
Lead Analyst. This table brilliantly illustrates their dual-engine strategy. You have the massive High-Touch Solutions North America segment, generating a massive $14.0 billion in 2025, with a stellar 16.8% adjusted operating margin. Then you have the Endless Assortment segment, which includes their digital, e-commerce platforms like Zorro and Monotaro, bringing in $3.6 billion. But look at the bottom line here, a total company adjusted return on invested capital, or ROIC, of 39.1%. Let me explain ROIC in construction terms really quick. A 39.1% return means for every single dollar management pours into building out their warehouse network or expanding their digital infrastructure, they are generating an incredible return. It is the ultimate measure of management efficiency.
I mean, that 39.1% ROIC is incredible, I can't argue that. But wait, look at the Endless Assortment margin right above it, only 9.8%. That's a significant drop-off from the high-touch side. As their digital e-commerce segment inevitably grows faster than their traditional business, isn't that going to create a structural headwind for their overall margins? Even management noted segment mix headwinds. I just want to ensure this lower-margin digital side of the business isn't going to end up dragging down the whole building over time.
It's definitely not dragging it down. The Endless Assortment margin is actually improving. It was up 40 basis points in Q1. And overall, the earnings across the board are surging. In Q1 2026, diluted EPS came in at $11.65, up a massive 18.2%. But more importantly, they produced $739 million in operating cash flow in just 3 months. Remember, net income can be manipulated by clever accountants, but operating cash flow, that's the actual, hard cash moving through the pipes of the business. And management is so confident in the structural stability here that they raised the full year 2026 EPS guidance to a range of $44.25 to $46.25.
Market Skeptic. An 18.2% EPS jump and a guidance raise to a midpoint of over $45? That shows some serious internal confidence from the executives. And generating $739 million in operating cash flow in one single quarter means the business is absolutely printing money right now. But, as we say around here, a strong income statement doesn't mean the foundation is completely immune to earthquakes.
Which leads us to the next section. Are there cracks in the armor? It's time to take a real look under the hood.
Bring it on. I welcome the stress test. Let's look exactly at what they owe and what kind of leverage they are carrying into this highly uncertain macro environment.
All right. Well, as any good builder knows, you don't judge a skyscraper by its fancy lobby. You judge it by how much stress the foundation can actually take. So here is a number that acts like a potential wrecking ball. $2.5 billion. That is Grainger's consolidated indebtedness as of the end of 2025. That is a heavy, heavy load of long-term debt. If the economy takes a sudden downturn, could this leverage crush their business flexibility and force them to divert all that great cash flow just to service those interest payments? Look, $2.5 billion sounds like a lot in a vacuum, but you really have to contextualize it with the sheer scale of the company. They generate roughly $2.7 billion in operating income annually. Their annual interest expense, it's only around $77 million. That means they can cover their interest payments more than 34 times over with their operating income alone. In a high interest rate environment where borrowing costs are literally crushing weaker companies, being able to cover your interest expenses 34 times over is extraordinarily rare. It reinforces the iron financial mindset of investing in pure resilience. That is not a wrecking ball. That is extremely well-managed leverage. Let's counter that debt fear with the actual leverage metrics. Grainger operates with an extremely safe total debt-to-equity ratio of 0.69. Furthermore, their current ratio sits at an impressive 2.72. To translate that into plain English, it means if every single short-term creditor knocked on their warehouse doors tomorrow, demanding their money, Grainger could pay them all off almost 3 times over using just their current liquid assets. This balance sheet is rock solid.
Okay, a 0.69 debt-to-equity ratio is undeniably conservative. I'll give you that. But we really need to talk about their working capital lumpiness. Financial analysis shows that in recent quarters, they experienced significant volatility in cash flow, and that included a $250 million negative change in working capital, driven by increases in receivables and inventory. Let's explain what that actually means to the viewer. It means their cash sometimes gets temporarily tied up sitting in unsold inventory in those massive warehouses. If inventory piles up and customers take longer to pay their bills, that rock-solid liquidity can dry up way faster than you'd think.
And speaking of liquidity drying up, let's look at this potential red flag. In 2025, Grainger returned a massive $1.5 billion to shareholders through dividends and very aggressive share repurchases. Now, because these shareholder returns outpaced their free cash flow generation for a period, their cash balance recently dropped from over $1 billion down to $535 million. Are they prioritizing stock price manipulation and buybacks over maintaining a safe cash buffer for a rainy day?
That is a fundamental misunderstanding of their cash generation power. They are deploying capital efficiently, not recklessly. They aren't just hoarding cash uselessly in a bank account. Buying back stock at these levels shows management fundamentally believes their own stock is still a great value. While the cash balance fluctuated, remember, they just generated $739 million in operating cash flow in Q1 2026 alone, and they ended March with $695 million in cash and cash equivalents. Plus, they maintain a massive revolving credit facility, which gives them over $1.8 billion in total available liquidity. They are returning excess capital exactly as a mature, fortress-like business should.
Fair enough. The cash engine is still running strong. But how about the people behind the wheel? Recent SEC filings show that CFO Deidre Merriweather sold 2,339 shares, cashing out approximately $2.49 million and cutting her stake by about 18.6%. Now, if the chief financial officer, the literal person who knows the books better than anyone else on Earth, is selling off nearly a fifth of her position, is that a structural warning sign we should be paying close attention to? Insider selling can definitely be a red flag, but context in the financial world is absolutely everything. Executives at this high level almost always use automated, pre-scheduled 10b5-1 trading programs. These plans trigger stock sales automatically at predetermined times or prices, completely irregardless of current market conditions, usually to handle tax obligations or just for basic portfolio diversification. It doesn't inherently mean the company is failing. Given the massive earnings beat and the raised forward guidance management just put out, this looks exactly like routine portfolio management by an executive, not some panicked exit from a sinking ship.
Well, it seems Wall Street is just as hesitant as I am right now. Let's shift over to the Wall Street blueprints. According to Ticker Nerd's consensus of 19 top analysts, Grainger only has 4 buy ratings. The vast majority, 12 analysts, are just sitting on the sidelines with hold ratings, and 3 are outright telling you to sell. If this company is such an ironclad powerhouse with a massive moat like you say, why is the smart money overwhelmingly neutral on it? Because Wall Street analysts are often looking in the rearview mirror. And frankly, they are scared. They see the incredible run the stock has already had, and they are terrified of looking foolish by recommending a cyclical industrial stock at what they perceive might be the absolute top of the economic cycle. A hold rating often just means they missed the initial breakout, and they are waiting for a dip that may never actually materialize. Let's look at the actual valuation numbers that have them so spooked.
Yeah, the number spooking them is 32.3x. That is Grainger's current price-to-earnings ratio. Let's contextualize that for everyone. For a business that basically stores metal parts in a warehouse and puts them on a truck, a 32 PE is astronomically high. You are paying a high-flying tech company multiple for a traditional industrial distributor. We really have to ask ourselves, are investors paying penthouse prices for an industrial basement? Are we buying at the absolute top of the cycle just before demand rolls over?
You pay a premium for premium quality. Yes, 32.3x is undeniably rich, but you are buying a 39% return on invested capital, 40% gross margins, and a company that just confidently raised its earnings guidance while others are faltering. In a market full of weak, unprofitable tech dreams burning cash left and right, paying a premium for a highly profitable, resilient infrastructure play is exactly how you forge a stronger, long-term portfolio.
But look at the sheer valuation gap here. The current stock price is hovering right around $1,169.86. The median Wall Street price target for the next 12 months is $1,170 flat. That is literally a 0% upside. If the so-called financial experts see absolutely zero room for this stock to run from here, why should everyday investors risk their hard-earned capital buying in right now? The data suggests that all of this incredible growth and margin expansion is completely priced into the stock at these levels. Because price targets are a lagging indicator. Analysts consistently revise their targets upwards after a company consistently beats earnings, exactly as Grainger just did with their $11.65 Q1 EPS. The median target is static. The business is highly dynamic. Plus, you aren't just relying on capital appreciation with Grainger. You are getting paid handsomely in cash while you wait for the stock to move.
And this brings us to the ultimate proof of their structural durability. 54 consecutive years of dividend increases. Grainger is a certified dividend king. Think about what that actually means. Through the 1970s inflation crisis, the dot-com bust, the 2008 financial collapse, and a global pandemic, Grainger raised their payout. Every single economic earthquake of the last half-century, and the dividend kept growing. Not only that, but they just announced another 10% quarterly dividend increase alongside their Q1 results. You don't manage a streak like that unless your underlying business is truly ironclad.
Okay, 54 years is an undeniable track record, I have to admit that. And a 10% hike shows they aren't just maintaining the payout to save face, they are actively growing it. For an income-focused investor, that kind of predictability is a massive selling point. It certainly softens the blow of that steep 32x PE ratio if you know those dividend checks are going to clear your account every single quarter without fail, regardless of what the broader stock market is doing.
It's time for the verdict. On the bull side, you have a foundation that is fundamentally unbreakable. Fortress-like 16.7% operating margins, an absolute tsunami of cash generating $739 million in just one quarter, and proven pricing power that fully protects them from supplier inflation. They are growing top-line revenue by double digits while simultaneously expanding their profitability.
But on the bear side, you have cracks that are visible if you look closely. You are paying a penthouse 32.3x PE valuation in a very fragile macroeconomic neighborhood that might be facing a recession. Working capital volatility is a real factor, and Wall Street consensus currently models literally 0% median upside. It is a fantastic company, but it might be a dangerously priced stock.
We've laid out the blueprints and run the hard numbers. Grainger is a fundamentally elite distributor executing at the absolute highest level. But the broader market has certainly recognized that excellence and attached a very premium price tag to it. At Iron Financial, our mission isn't to tell you what to do, it's to give you the unvarnished data so you can forge your own decisions.
Exactly. Is GW the heavy-lifting steel beam your portfolio desperately needs to weather the coming economic storm, or is that 32x multiple a heavy valuation trap waiting to pull your portfolio down? The ultimate question is, are you willing to pay a premium price for peace of mind, or are you better off keeping your cash in the bank? The market opens at 9:30. Forge your path. Thanks for joining this session. Stay focused, stay disciplined, and keep building a stronger portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.